That's the standout. It's the profound stampede of foreign money hitting the immovable object of these rare AI stock platforms et al. And here we are with stock markets heading to 30% on the year.
So do you, I don't want to put words in your mouth. Are you making a parallel between now and the Roaring 20s? Do you see this as a Roaring 20s kind of part two?
Yeah, no, I do. I mean,
welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a wonderful discussion lined up. We're fortunate to have with us Hugh Hendry. Hugh is a former global macro hedge fund manager, currently distilling market insights via his alter ego, the Acid Capitalist. Hugh, thank you so much for joining us today.
Oh, a privilege, a privilege. You know, I get lonely. You know, I don't think I've spoken to a human in 24 hours. So even remotely, I welcome the opportunity, Gary.
Man, I am so honored. Thank you. All right. Well, let's begin with a look back on 2024 from an economic and market perspective. What surprised and shocked you? What fell right in line with expectations? And what are you expecting moving into 2025?
Heavens, wow. I expected the inflation in the consumer price index to moderate in the manner that it has. We've had inflation print today. Inflation now is boring. We're measuring the wrong inflation. And in terms of surprise, it was the other inflation, the inflation that makes a difference, which of course is the asset price inflation. So the lift in equity risk assets is, it's not just this year. The last 5 years, the returns have been. We did have that down year in 22, but then the markets have almost doubled since November 22, and I'm doing I'm talking to you, and I'm replaying my podcast for this week, where I just vibing into the universe of nonsense. But one of my like everyone, I don't read enough, or maybe I do. Like you're never sated with potential wisdom. But one of my go back to books is The Lords of Finance by Ahmed something brother, won a Pulitzer, and it's the day-to-day tale of the central bankers in the 1920s, and it's just got wonderful detail. But for instance, the Dow Jones, it took it 12 years to double between 1913 and 1925. Like one fact on its own, kind of, it requires more, so let's give it more. Well, that's like 6% compound growth rate during a period where you had obviously a world war, and we know what war and the suspension of the gold standard, we know what that does to prices. And so inflation is typically good for lifting asset prices. And so 6% a year over that period, pretty lame. But then we entered into a period of American exceptionalism, and this year's all been about exceptionalism. And I mean, it's such a damn long time ago that kind of no one cares. They're like, shut up, but the parallels are eerily familiar, because we had a trade system, and we got to talk trade because it's just trillions and trillions and trillions of dollars every year. And it was conceived via gold, and it was conceived to be a system which would balance the world, where you'd have balanced prosperity, that we would be rising together. But as in so many other walks of life, people cheat. And so America was the China of its time, the trading superpower, surpluses with the rest of the world, perpetual, like year in, year out. Now that system with balance was designed whereby gold, and like you're a hard metals kind of channel, gold was the the reserve valve that would equilibrate the world. And so an economy with a great fortune and great industrial kind of heartland of America would be the recipient of gold. And that gold is like a virus. But it was designed to be the virus of easy money. That gold flooding into the U.S. private banking system would encourage further balance sheet, further credit expansion. That the U.S. economy would boom even more, and people would get richer vis-a-vis the rest of the world, which is to say that imports from the rest of the world would go up, and the system, would be level and rising. But instead, that didn't happen, and it tilted into the exceptionalism where Europe was on its ass, and the great icon was America. And as the axis tilted, all of the money from the rest of the world, it rolled into the US. So I said to you, 1913 to 1925 took 12 years. The same Dow between the summer of 1927 and the September of 1929, it doubled. Why did it double? Heavens, I've got palm trees. It doubled because of the tilt and all of that money sloshing and rolling its way in. So that's the standout. It's the profound stampede of foreign money hitting the immovable object of these rare AI stock platforms et al. And here we are with stock markets heading to 30% on the year.
So do you, I don't want to put words in your mouth. Are you making a parallel between now and the Roaring 20s? Do you see this as a Roaring 20s kind of part two?
Yeah, no, I do. I mean, I'm staying in the servants' quarter today, recording from the ghetto in St. Bart's. But I mean, St. Bart's is a huge metaphor. The Great Gatsby life, heavens, it's here, and it's in the communities around Wall Street, and they're partying like it's 1929, and exceptionalism with stocks. I mean, it's hopelessly out of step with the time. But I'm just noting down my reservation. I don't like that philosophy, and the sheer magnitude of the returns. I can understand why, but I have no ability to determine just how fragile or durable these levels will be. Like from being involved in markets a long time, I think the durability is questionable. Did radio kill the video star? Was radio the AI of the late 1920s, the RCA?
I believe it went, I think it lost like 90 something percent, didn't it?
Well, yeah. I mean, so first off, the revolution, it was broadcast. It was glorious. It was even better than the prophets proclaimed. But to your point, it took RCA 25 years to regain the same price levels. And of course, more recent to time, at the turn of the century in the year 2000, we saw the same thing about 20 odd years for some of these gigantic and fabulous internet platforms to establish new highs.
So I do have a few questions regarding the market specifically to tag onto this, but I first want to ask you a couple of other questions. So Hugh, I want to turn to trying to recognize the current flaws, the blind spots, if you will, that are overlooked by the smartest investors. What do you see as the prevailing wisdom and therefore blind spots that you're currently challenging? And what do you view as currently being overlooked by the investing herd and the financial managers?
Well, I mean, the herd is an all-encompassing term, but the professional community, of course, is infected by franchise risk. I mean, like imagine stepping in front of this thing. Imagine saying, I'm out or God forbid short. I mean, no pro would be short. So that's there. The experts. I mean, the person that I have the greatest admiration for, the person I think is the greatest investor on the planet, is Druckenmiller. And I'm out of sorts with the great Stan. Stan's short the long end of the treasury market, and he's short. I mean, Paul Tudor Jones, another great icon. is kind of long, a steepener, but Stan's very confident just saying, I mean, he's not hugely short. I think like 30% NAV short. I mean, in risk terms, it's not a great deal. But he's short on the basis that he believes that the 10-year US Treasury yield should trade at it in line with nominal GDP. And nominal GDP is like north of 6%. And it looks like it's going to hang around those levels. I don't dispute that. What I do dispute is the notion that nominal GDP growth will be the go-to for the 10-year. And I dispute that because whilst it sounds neat and logical, and Stan is nothing but a genius at both, but it's kind of never really traded there. I mean, the textbook would tell you that would be a go-to, but the last 40 years, it has shown no relationship whatsoever. And I don't think that's a surprise because I think it reflects the macro condition. And the macro condition is overwhelmed by China. I could bore you to death, but the Chinese model, which has parallels with the American model in the 1920s, but it's one of overcapacity. It's one of promoting national tech champions, and they're promoted to expand at the expense of profitability. Yeah, so we eradicated profits out of the old, the software for 4G, 5G base stations, critical to our development as a society. The old Nokias and Ericsson dinosaurs, the Chinese eliminated profit. They did the same in solar panels. I mean, this is not a whinge. I'm just trying to be factual. This is a different model, a different system. They removed profit. They're doing the same in electric vehicles today and gaining a tremendous dominance, a profitless dominance. I mean, their stock market trades at the levels we saw back in the worst moments of the great financial crisis. Now they're trying to do something about that, but I'm kind of not sure what they can actually do. But the profitability, I want to say to you, I lean heavily on an old and dead economist, Mnt&x, a Swedish economist, and he wrote about the natural rate of profits, and by implication, the natural rate of interest rates. And the natural rate of profits, I mean, here we are with the absurdity of markets so high, and profits as a share of GDP high, but actually the natural rate that encourages an entrepreneur to want a greenfield and to actually, break land and have a big productive investment, it's not there. And I think that owes much to what's happening in the rest of the world. And I think that's the reason this very kind of low, and when I say profits, I'm ignoring the impact from interest rates, tax rates, share buybacks, et al. And I'm talking about just that. I'm a US manufacturer. Am I going to expand capacity? And the natural rate of profit there forbids it. And so I believe that the interest rates will come lower, that they have to find a berth which is more appropriate to where we are with profitability. And this situation is set to continue for as long as we quite frankly, we accommodate the Chinese trade model. Now, tariffs on goods and services, I would say to you that is a filibuster. It's an accommodation that maintains the status quo. The true answer would be to close or reduce the US capital account and stop the hordes of overseas money seeking exceptionalism and bidding US stocks into levels where future potential returns seem modest at best.
So the lowering of the interest rates is, in your mind, inflationary on the asset side, and that's going to continue. We're going to continue to see elevated assets as they lower, as the interest rate basically naturally lowers down and finds its equilibrium.
Yeah, I mean, I'm saying to you that the S&P is up 60 times in 40 odd years. Okay, and that is in sync with the rise of China from nothing to the second largest economy. And that model where they interfere in the market price, there's no market price for the Chinese renminbi. I call it the red cabbage. It is a dictate by policymakers. And the cost of achieving that is the cost of pouring money into the US open capital account and bidding up asset prices. So we've had, I would call it the worst of all wars. We've had asset price inflation and the disinflation of the global labor pool. Now we're seeing strife in the social, heavens, it's raining. We're seeing strife in the political economy. But the vested interest is so great because if you temper or close the capital account, you would bring down US asset prices. And the big money is not voting for the end of Wall Street. So we're left with it. Ultimately, we're human beings, and trees don't grow to the sky, and everything will run its course. Now, running its course would be that the Chinese trade surplus finds it increasingly hard to maintain its growth rate. And actually, perversely, in doing so, it siphons off because as asset prices go up, as you have $3 trillion stocks, the amount of liquidity, the force and the energy transfer, you need exponential force. And we're talking about one of the principal fuelants potentially being drained and coming down. So that could be a natural resolution, but these are resolutions which would impact negatively the value of, quite frankly, all global asset prices.
So Hugh, a few days ago, I'm going to shift here for a little bit. The Google CEO introduced Willow, their new state-of-the-art quantum computing chip, with a breakthrough that can reduce errors exponentially as they scale up using more something called qubits, and cracking a 30-year challenge in the field. In benchmark tests, this computing chip solved a standard computation in less than 5 minutes that would take something like 10 to the 25 years, far beyond the age of the universe, according to what they're telling us. Should this breakthrough and capability scare us?
I think we should rejoice. I think it's amazing. I'm the acid capitalist. I named it after a fellow Scot, a world-renowned psychologist, and he was the acid Marxist. Now, Marxism has failed so far, but it's failed owing to its abject pessimism with regard to the human spirit of endeavor and ingenuity, that we're continuously devising means to push out that frontier of prosperity. And so AI and these chips and whatever, like I say, the revolution has only just begun. I'm pretty sure it will be 10 times more fabulous than we even think today. But that doesn't give me the certitude that a NVIDIA is more likely to, if we think of it being a normal distribution and we think of the two standard deviations, the 66.666% probability, everyone is kind of hedging that NVIDIA is going to be 6 trillion. And I'm kind of hedging that it might be like 1.5 trillion. Why not? We saw, I said to you, the stock market has almost doubled in less than 2 years. In 2 years. We could talk about Palantir. I mean, Alex, the CEO, I mean, he's an asset capitalist. I love when he speaks. And again, he was talking at the Ronald Reagan Defense Conference at the weekend. It's on YouTube. And talking about exceptionalism. Now, his stock has gone from $20 to $80 in 5 months. This is the environment where, it's wonderful. And it's wonderful because of these stories of what we can do, how we will overcome challenges, and we will make our life better. But in this febrile environment, stocks and indices can have a 60% correction. It's actually, that shouldn't be a big deal.
That's exactly where I was going to take it. So if we're in the roaring 20s right now, part two, we all know what happened after the roaring 20s. Starting in 1929, it dropped 89%. You're talking about NVIDIA going from a $3.6 trillion market cap to a $1.5 trillion market cap. Wouldn't that pull down the entire market?
Yeah. So, of course it would. But I mean, let's be frank. I mean, call me Nancy if you want, but let's be frank. The You ain't going to short the market, right? And it's really hard not. You should always have exposure to stocks. Yeah, I mean, you get a positive risk premium, and my God, I mean, they just trend. I mean, we're all fascinated about Bitcoin, which has been around for what, 14, 15 years. Stock's been around for, I don't know, the Dow. When did they start printing the Dow? 150 years ago? And statistically, I mean, that thing goes up. I mean, in it for the long run, Uncle B, etc. But so how I try and square that circle is I try and have the market spinning really fast, and I try and invest my creativity, my ingenuity into my brake system, and I try not to get caught up in that and the frivolity of that, and I try and have like tails. So actually, and I mean, and who knows, but the thing about a tail is on an ex ante basis, as you put it on, you're expected to be wrong. I like that. Yeah, I like being expected to be wrong. I'll show you. But the price consequences of being wrong are not, they're not devastating. Far from it. But the returns are devastatingly good if you're that guy. And so, we were talking about interest rates, the natural level of profitability, um, the global overcapacity, a huge sovereign nation uh, spurring on its companies at the expense of profits. And I'm looking at the Canadians. Um, the loony. Tell me, you know this better than me. Loony's a plant, a natural. Is it on the? It's not. Is that the maple? What's on the flag? But we call the dollar Canadian cross the loony. And people are like, have they gone loony? They just hit rates down, cut again today, 50 basis points. They did the same the last time. I think they've had 5 cuts. Um, I've got the kind of expansive, high imagination to imagine the Fed could be doing that next year. I kind of the return on the return on kind of taking the bet where you're supposed to be wrong in SOFR, which is to say like interest, like Eurodollar interest rate expectations for the Fed. Um, I'm like using option packages. I'm not buying premium. I'm selling premium, but I've got convexity if interest rates are very low. So that's one thing. The It's all been one sided with Trump and retaliation in China, but it's so late in the day to decide to dump your lover, so to speak. Like there's a lot of cross interconnectedness, and China's got a lot of powerful little kind of buttons that can press, and it can be damn painful. So, they're I think their currency. I mean, I think their big statement this week that we're going to do more. Um, they have to do more on the currency because it's not Faustian, but the parameters of what they can do have been sacrificed for the currency. Most of their import and what they can do, import in terms of significance, will be via the currency. And so big US tariffs, big currency devaluation, question mark. So there are things one can do.
Appreciate all of that. It's a very interesting discussion. I want to shift over to a geopolitical question for you. So, geopolitical destabilization seems to be the plan of the day. France's government is collapsing. Germany's government is collapsing. South Korea's government's collapsing. Georgia's government is collapsing. Syria's government has collapsed. And today, someone in the American government has announced that the random drones that have been seen over New Jersey are from Iran, and that Iran has planted, and this is his words, a mothership off the East Coast to control the drones. This is somebody from the American Congress. So it looks like the next country that they want to destabilize is Iran. Is all of this a coincidence? In your view, what's coming next once all of this destabilization is complete?
Well, I mean, again, I mentioned Palantir and their chief executive, who was talking on these very, very subjects at the weekend. And, there's people, prosperity in our form of democracy. You can slap us, you can call us names, and we don't go and lock up your family. Like we're a democracy, like we're just superior. The reason we have contract law, the rest of the world, people queue outside embassies to try and join, the American community. You don't see that anywhere else. But there are some bad folk out there, and a giant. Yes, it can be magnanimous, but a giant that doesn't squat fleas away is a giant with a lot of fleas. And the Palantir rhetoric was, we are a very, very peaceful nation, a democracy, but you really don't want to mess with us and the technology we have. And so if it is your solemn promise to do us ill, I mean, we're coming after you, and seize their assets. That this nonsense about Russia and how we froze reserves. Yeah, freeze it. They're piranhas. Go to the nth degree to bring discomfort to your enemies. But maybe again, that is exceptionalism, and maybe these are bodacious comments from individuals whose stocks have just quadrupled in 5 months. And with markets enjoying perhaps one of the most elevated periods in history.
Is there a connection here in your mind at all, in any way, shape, or form, on the continuum between what's happening all over the world, all the destabilization, and the American dollar, or even the stock market and all the money that's coming in from all over the world, et cetera? Is there any connection in your mind that you see?
Well, yeah. I mean, we discussed that at the introduction, that the nature of global economic growth, that the axis of the world is spinning in an uneven manner, which is very, very fortuitous. Fortuitous, hard earned, I should say, by the American economy. And for all those listless, I think you forgot Romania. They've had to suspend elections. There isn't a day that passes without something else. And yet America, right or wrong or whatever, but within 24 hours, they had changed all seats of government, and without controversy, smooth. And so an axis tilted, and money, it's not rolling downhill, but it's rolling into America for all the reasons we discussed.
So global central banks have conducted 63 rate cuts over the last 3 months, the most since the 2020 pandemic. That includes Canada, that you mentioned earlier, lowering by 50 basis points earlier today. This is the fourth fastest pace of rate cuts this century. To put it in perspective, during the peak of the financial crisis in 2009, global central banks implemented 76 rate reductions. So 76 versus today's 63. Then you still have the European Central Bank, the Swiss National Bank, that are expected to cut rates further next week. And then that's followed by the Fed, that everyone thinks is still going to cut rates at least this month. Central banks are calling for a soft landing while cutting rates like we're in a recession. What do you see is really happening here, and how interesting of a year do you expect 2025 to be?
Well, again, there is a profound problem with inflation, but it's the inflation in asset prices. I would much rather see a world where we had inflation in the labor stock. There is this myth that a high rate of wage growth is bad. It's positively good. When you start from this level of how you distribute GDP and the labor share being so small, it can take decades of really good increases. And we live in a world where there is a lack of demand, not from the folk that come here to St. Bart's, but by the ordinary folk, struggling to make it, and again, the technology is going to make that tougher. And we don't measure the asset price inflation, but we measure the inflation or lack of inflation in the labor pool. And so because that corrupts when there's less demand. And what I mean by less demand, so China's, let's see if I can do the maths, China's $18 trillion. Consumption, there's many definitions, and unfortunately they introduce a lot of government spending into some of the national consumption statistics. But we know that consumption in America is 65-70%. And on the same metric in China, it's probably around 30-35, which is extraordinarily low. Now, if it was, so we're missing 30% of GDP, right? Now, 30% of 18 billion, I want to say, is $6 trillion. Yeah. That's $6 trillion every year. Like, so if like you discount that and like try and get a present value of what we're missing between now and the end of time, it's an enormous number, right? And again, that's why interest rates and wages and the like are low and probably getting lower. And that's the mechanism of the helium which inflates asset prices. So it's really not the purview of the Federal Reserve. It is the need for society to kind of have a reset moment. It has to decide what it wants, and people, by and large, vote for the status quo. No one's going to vote for, the S&P dropping 60, 70%. No one's going to vote for their house prices falling, even if within 5 or 6 years there would be tangible signs that you'd be getting better jobs, you'd be getting paid more. They're not hearing that story. They're not aware of the trade-off. And so it still may happen, but it'll happen via an event. It'll happen because when the monster can't grow anymore, the monster just dies. So
are you expecting a reset moment? Is it inevitable?
I think it's inevitable, but is it a week on Tuesday? Is it next year, the year
Right.
after?
Yeah.
Here we are, and the Federal Reserve cut rates in September, and it cut rates again, and they'll cut rates again on the 18th. And US GDP nominal growth is 6, and the real indicators are 3. But they'll cut interest, and indeed, I'm betting they're going to cut interest rates a lot more. Strange times.
All right, so we're talking, the cycle here and where are we? Who knows where we are in the cycle? But let me ask you this: so after the suspected United Healthcare CEO shooter Luigi Mangione was captured, a coin, a digital coin called the Luigi coin, it jumped 35,000%. It hit a market cap of 55 billion with 55 million with 100 million plus in volume over the last 24 hours. What part of the cycle are we in when we see something like that?
Can I? You can hear me, okay?
Yes.
Yeah, perfect. Okay. This is okay. So 2000 protests, Occupy Wall Street was so 2011, right? But here we are many years later, and wages are still shitty, and asset prices are in their ascendancy. Okay. Nihilism, Robin Hood, Reddit, GameStop, the meme culture is a manifestation of the anger of the majority that have the spoils of so little. Okay. And they're bringing nihilism into the financial casino. MicroStrategy. Yeah. I think had it gone up 4 times from, I was talking about Palantir, June to December, 4 times. I think MicroStrategy went up 4 times in a month, right? It's legitimate anger, but it's crazy anger. Buying MicroStrategy at like almost 3 times premium to Bitcoin. Yeah. Not many good things are going to happen. You do have to exit.
Where does that anger lead? Does it just stay bubbling under the surface like this, and every once in a while we see like a popcorn moment of anger, and then it gets squashed down, but things keep going the way they're going? Or does society come to a breaking point at some point saying this is too much, the load is too much to bear?
Yeah. Well, clearly again, it's happening everywhere but America so far. The French economy is now firmly split into 3 camps, 3 immovable objects of dogma, and it's leaderless. Yeah. And Germany, they've tried crazy Greens, they've tried boring Angela, what else have we got? UK rejected the European system. Japan had elections in November, and the ruling party is waver thin. People like, anyone but you. The Kamala or whatever who couldn't go on a Joe Rogan show. Like they know Trump is. I mean, like, come on, he's repugnant, right? Um, a repugnant Republican. But the money around him are smart, you know. But they're like, at least he is legitimately repugnant. You are the Wizards of Oz. You're a wizard that has no power, and we're done with you. But with America, we either spin the wheel again and wait 4 years, or of course, what we haven't mentioned is the godforsaken possibility that China will take Taiwan. And remember, it's the president's most influential advisor believes it's a certainty. Um, I'm not saying we will have a world war. I do not believe we will. I believe Trump will negotiate a transaction. Um, but there's at the end of the year, there's a lot of things to contemplate. And actually, I take it back to the parables with the election of Obama. Literally carried on the arms, the shoulders of men, such was the exalted expectation. And it feels a lot like that, rightly or otherwise, but just as an emotion that you can calibrate, almost touch and feel, it seems profoundly strong. And
So
back then, yeah.
I was going to say, despite the fact that he was elected with all of these expectations and, everybody was thinking he's going to fix this as things were nosediving into his inauguration, he did not fix things right away. He was incapable of fixing things right away. If we have a similar moment, is it more cycle driven and incapable? It's out of the grasp of the person, in this case Trump, of being able to fix it. He's just incapable. It's the cycle that's doing it.
Well, it's the cycle and it's the sponsoring agents. Like I say, I think the cycle, we've got two trends: asset prices higher, and the lifestyle and the reward from being unskilled being rewarded less and less, and that creates tension in the political economy. But Washington is controlled by big money, and they ain't voting for changing the status quo. They will have to be evicted. Can we find me? It's not for me. Will democracies find a means of usurping big money? I'm not very confident about that. But the exaltations of Obama met the macro condition, and the reputation of the man falters. I mean, in terms of what he was promising, and I just feel that there's an inevitability about Trump, and again, it's the what's it called, the Treasury Minister Besant. What do you call that office?
Secretary of the Treasury.
Secretary of the Treasury. Thank you very much. Gets to sign his name on the dollar bill, but he's a hedge fund, right? And no one's voting to close the capital account. So status quo persists, and the only game in town is Wall Street.
So let me ask you this, and this kind of ties in a little bit with what you just said there, with Wall Street being the only game in town. President Trump posted on his Truth Social account the following: any person or company investing $1 billion or more in the United States will receive fully expedited approvals and permits, including, but in no way limited to, all environmental approvals. Get ready to rock. So do you see this as the beginning of some kind of U.S. mining boom, which is so desperately needed for the electrification of everything and the clean energy revolution? Or do you think this is something completely different?
I do not see it as the beginning of a mining boom. I think we had it. Again, let's eulogize about stocks. You get a positive risk premium, which you don't get in the commodity landscape. Depending on the shape of the curve, we have these technical terms: contango and backwardation. But typically, if the prospects kind of look encouraging, you actually have to pay more for the future today, and in terms of where you buy the future. You don't have that with stocks. And the commodities, they can have incredible moments in history, and I think they've had that incredible moment in history. Again, it was I can't say preposterous, but the sheer magnitude of the commodities consumed in the rise of China. Incrementally, your delta, your rate of change, it's never going to surpass what we saw.
Interesting. All right. Well, hey, this has been a fantastic conversation. Before we wrap up here, and I ask you our final question, I want to point everyone to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Hugh as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. It's now time for the Golden Nugget segment. Hugh, let's discuss a future scenario that I've been asking several of my guests lately. Picture a dinner party, Christmas 2029, with two tables. One table's very happy for what they invested in beginning this year, 2024, 2025. It helped to give them financial freedom. And one table's very sad as what they invested in beginning in 2024, 2025, because it did not help them. In fact, it hurt them in the long run. What do the two tables represent in terms of asset classes to you?
It is really raining in St. Barts. I think it's all this. It's our miserable conversation. Wow. I mean, guys, it's as if you had prepared that question, and because everything we've talked about for the last 30 minutes has been those two tables in terms of social classes. If you put a gun to my head and said you can only have one investment today for the next 10 years, it'd be Bitcoin. Why is everything free on your Substack? I mean, this is America. This is capitalism. If it's good, charge for it. But anyway, I'm on Substack. I charge $20 a month. I'm not going to eulogize about Bitcoin. Do you know that literally today's what, the 11th, 12th, 13th? I don't know. But on the 4th of December, 2013, someone brought this to my attention last week. I was at an investment conference, and I said, the one asset that I would like to own is Bitcoin. I think it can go to $1 million. Now, it was very, very, obviously, it cost peanuts back then. I said, it's not qualitative, it's trending. But sadly back then, no ETFs, no option market, no futures market, no place, no home for a hedge fund like mine. And back then, I was extolling the virtues of buy everything. Yeah, that the macro condition meant that what I expected to be the course of asset prices would be higher. I think that prophecy's come true, and here we are. Bitcoin is not 1 million, but it's 100,000. But we should take away from these numbers, they're labels, blues, rhythm, jazz, they're labels, right? Bitcoin is an asset class, a trending asset class, the smallest asset class in the alternative investment sphere. And more importantly, a lot of my mind comes back again to where the power in the universe resides, and it's big money, and big money on Wall Street, big cigars. Like, the problem with the damn world is that NVIDIA is $3.6 trillion. I need something that's small, and I can bump, and I can charge fees. Give me something. And someone goes, Bitcoin. And he's like, genius. So I got very excited about Bitcoin when we started to see the sponsorship by the BlackRocks, these ETFs that they have, and then the nuclearization is beginning to happen now with the advent of options. When you put options, it's almost like fractional reserve banking for the stock price or the Bitcoin price. We went there in the early 1980s for the S&P, and here we are 60 times more. And finally, why today and why Bitcoin and not gold? It's mass. That the mass capitalization of gold is nearer $20 trillion, whereas for Bitcoin it's $2 trillion. And so the amount of force and energy transfer that I need to push the price of Bitcoin up to $1 million is way less than doubling the price of gold. If you double the price of gold, if you took it up 150%, it would be the same capitalization of all US stocks. And I can't imagine that happening.
Okay. Well, hey, Hugh, thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and ideas. It's been a lot of fun to spend the time with you. Would you share with the viewers any important message you want to leave with those tuning in, where they could learn about your work and about you more, and how they can connect with you, if you want them to?
I desperately, my brothers and sisters, I'm sure you're tuning in and you're hoping to hear from someone else, but I'm a minstrel. I'm an entertainer. I'm the greatest pole dancer you've ever seen, lyrically. And I'm on Substack. I'm on Patreon. Either Hugh Hendry or my, as you said, my alter ego, the Acid Capitalist. I'm on the Twitter. I'm on the YouTube. I'm even on Instagram. But I'm here not to agree with you. I'm here to sometimes upset you, but I'm here to nudge you into just conceiving of absurdity, because how often do we look back at these important moments when things go wrong and we say, but who could have guessed that? And I'm saying to you, normally I'm the guy.
Well, I'm going to put all of your contact information up on the screen. It'll be click throughable on, if that's a word, in the description area. And I've been following you for a few years. I really enjoy, you're enlightening. I enjoy your perspectives. I'm sure everyone who's listening has either heard you or at least knows your name. And if they haven't, they need to go follow you now. Check out his Substack, check out his Twitter. Hugh, thanks for coming on. Seriously, I look forward to having you back on. And everybody else, thank you for watching.
Yeah, thank you, everyone.
I want to point everyone to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.